right. Nice to be here, and we'll just quickly look at what we have for week 4. I've been trying to find the best setup to be able to give you the absolute best, and I just hope that this is way better. Yes. All right. So let's get down to it. Week 4, we are moving into a very interesting part of our lesson, actually. And for week 4, we are moving into importance of risk management. So ride with me as we go through this week's lesson. So let's talk about importance of risk management. So basically, without risk management, for you as a trader, even your best strategies might just hit rock bottom, and then you don't have a way to, move forward from there. So today, let's just break down what risk management is, and looking at it as your best leverage, your best friend when it comes to trading in the Forex market. So, why is risk management important? Imagine you are a captain of a ship. The sea represents the Forex market, and on the sea there are waves, right? Take that as price fluctuations. And then there are storms. Take that as the news event. We already talked about news earlier in this course. Also, we have when everything is just calm, nothing is going on. Think of that as consolidation. So your job as a trader is not to stop at the waves. You can't control the market. Your job is to navigate safely through them, and risk management is your life jacket. Basically, that's all that risk management is. So let's take this this 3 meaning of this risk management. Why do we need it? Why is it important? Everybody's talking about risk management and all that. Number 1 is that it protects your capital. The number 2 is that it helps you in surviving losing streak, because losing streaks are inevitable. And then it also ensures that you have consistent growth. So on the part of protecting your capital, the number 1 rule in trading is to protect your capital. And that is reasonable, because without money in your trading account, you can't trade. And then risk management helps ensure that one bad trade doesn't wipe you out completely from even trying to now make some money when it comes to Forex trading. Let me see. All right, we are still making progress. And then the second thing, okay, let's take an example. I think I have an example on my note. If you risk only 1% of your account on each trade, you would need to lose 100 consecutive trades to blow your account. And that's nearly impossible if you follow a sound strategy. Some of the things we've discussed earlier is showing you support and resistance, where you buy from, where you sell from. We're supposed to have a live session last week where we would have talked about how to enter a trade and how to exit them on a live meeting. So the composition of all that is going to contribute to your strategy. And when that happens, you are able to apply what we are going to be teaching here on this lesson. All right. So when you risk like just 1% of your account, to find out if you are correct, if you are right on your trade, it reduces, at least as a beginner, it helps you stay longer. And by stay longer, I mean it protects your capital. So you have $1,000. 1% of $1,000 is what? I think that's 10 or even 1. So big traders are looking for, your skill is supposed to grow into where if you have $100,000 account, you are not over risking money, right? And that is why risk management is very accurate. And then the second thing is surviving losing streak. As a trader that I've been here for about 3 to 4 years, been consistent at it, I can tell you for a fact that there will be seasons where you will just keep having these losses, and you even start doubting yourself as a trader, like, will I ever make it in trading? They will happen. But when you have inculcated risk management into your system, it keeps you around until the times now change for you. Because no matter the strategy that you have in the market, there will be times, intervals, where your strategy is being violated by the market. Most times it doesn't mean you have to change your strategy. Most times it is not just the conducive environment for that strategy. All right. So every trader, no matter how skilled, experiences losing streak. Risk management helps you to stay in the game emotionally and financially during this tough time. Think of this as having an umbrella during a raining day. The rain, which is like losing, is going to happen, but the umbrella keeps you dry when it's happening. So surviving losing streak. The next point we have here is consistent growth. I think I've mentioned it several times here that when it comes to forex trading, we are not trying to gamble and try to make the money for Ferrari in one day, right? The growth is consistent. If you have consistent win over a period of 6 months, you would have made more money from a job that you have made in any other place before, right? So with proper risk management, you can grow your account steadily instead of experiencing huge drawdowns and emotional stress. Small, consistent gains compound over time to build serious wealth. Don't forget that. All right. So we are done with the first leg of our lesson. Let's move on to the second leg. This lesson is not going to be too long, but I'm going to try and break it down for you to understand it way better. So position sizing means deciding how much of your account to risk. Okay, I'm doing a composition of risk management. And number one thing is position sizing. The number two thing is stop loss orders. And number three thing is risk to reward ratio, right? Which is usually referred to as RRR. So let's say the first one. The first one is position sizing. Position. Don't overthink what position is. It's like you just taking a position, standing somewhere, right? So in forex, when you buy or when you sell is what we call position, and the sizing there is your lot size. How much are you risking? How much are you getting in from that trade? So position sizing means deciding how much of your account to risk on each trade. A common rule is to never risk more than 1 to 2% of your trading capital on a single trade. Example, if you have $1,000 account, risking 1% means you only risk $10 per trade. This way, even a losing streak won't hurt you badly, right? You get that? So let me now explain how you use your lot size to determine this. Thank God for our MT5. I think you should go back and watch MT5 after this. On MT5, before we enter a position, we can project how much is going to be our stop loss. Follow me carefully. If my account is $1,000 and I want to sell EU, and when I check where I'll put my stop loss by using that tool on MT5, I am able to know how much money I will be losing. So I won't look for stop losses that are beyond $10 because of my account. Do you understand? Or if I want to risk 2%, how much is 2% of what is left in my account? That is what will determine my position, right? And that also will determine my lot size. If I put one lot size, I see that the stop loss, where I want to put my stop loss, is about minus $50. I'll change the lot size to 0.5 and so on and so forth. So that is it. Then, number two, stop loss orders. Just what I've explained now, but in a more relatable way. A stop loss order automatically closes your trade if the market goes against you, limiting your loss. Think of it as setting a boundary. You decide in advance how much you are willing to lose. So you put that automatically there. We make some rookie mistake where we say we have mental stop loss. Oh, I'll close my trade when it gets here. What if a news comes out and then it goes beyond, like a lot of miles and blows your account. So stop losses are also a great component of risk management. The next one is the risk ratio reward, which balances out where we set our stop loss. We are not only here to come and be taking stop loss, we also want to take profits, right? So this risk to reward ratio, this measures how much you stand to gain compared to how much you risk. A good ratio is at least a 1-to-2 ratio, meaning you risk $10 to make $20. This ensures that even if you win only half of your trade, you remain profitable. This is like the most interesting thing when it comes to Forex trading. Let me give you a mental picture. So when I also see the possibility, before we enter a trade, we have an entry strategy, we have an exit plan. And I see that if I put my stop loss here, it will take $10. And there's opportunity for me to make $20, right? If the first trade I lose $10, my account is down to 90. I see another setup, I risk another $10 and I lose. My account is down to what? It's down to 80. On the third trade, I see a position and I get $20 out of it. What happens to my account? I'm back to 20. If I win the next one, I'm back to 120. If I lose the next one, I am back to 110. Do you understand? So that is how it goes. And gradually it climbs up. So that is what the composition of all this means. All right. Told you this part of the segment is going to be small. On our live sessions, I'm going to show practically how we apply all this. So practical exercise. I need you to open up your demo account. I should have set up that demo now. By now, you should have the demo account on your MT5. And set up 3 trade with different risk ratio reward. You know how to set up trades now from our support and resistance, whatever. Use that and set your stop loss for one position where you are risking 10 to make 10. Another position where you are risking 10 to make, because I think we set your demo account on 1,000. So you are losing $10 to make $20, or you are risking $10 to make $3, right? So observe how these different sizes affect your account balance and how you feel when you see the result, because some are go into losses. All right. So key takeaway: Forex trading is not about winning every trade. It's about managing your losses and protecting your capital. Secondly, a solid risk management plan helps you trade with confidence, knowing that a few losses won't break your account. And lastly, the most successful traders are not those who avoid losing, but those who manage losing well. I should post that on my social media. Conclusion: risk management is your safety net in Forex trading. As you continue to build your trading toolkit, never underestimate the importance of protecting what you have while going after what you want. That'll be that on this episode. And until the next one, I'll see you. Cheers.